Hello and welcome to Standard Costing Part 2, Direct Labor Variances. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2020 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Presentations from time to time use information from third parties or the third-party information. The third-party information is the property of those respective copyright holders, and the author does not make any claim to the third-party information. So today we're going to be looking at direct labor variances. And again, what are we trying to do here is that, remember the different components that go into work in process. That is going to be direct labor, direct materials, variable overhead, and fixed overhead. What we're doing is we're developing direct standards for direct labor, meaning how much will it cost us to go through and manufacture our product. What we're going to do is we're going to be comparing what we think it should have taken to create a unit versus what we actually spent in terms of creating a unit. You're going to notice many similarities to direct materials in this analysis. However, with that being said, there's also a difference in terms of the way we use the terminology. So what can cause direct labor variances? And this accountingsimplified.com is a great reference or website when it comes to this. Is that when do our direct labor issues or challenges, like when can things go bad? So if we look over here in terms of the various different, what causes a favorable labor rate variance might be the hiring of more unskilled or semi-skilled labor. So again, that might help us out just because if we can hire people at a cheaper rate, but however, they may not be as efficient, that can really go either way. Decrease in the overall wage rates due to the market for an oversupply of labor. And then over here, you've got an inappropriately high setting of the standard cost of direct labor. So if someone's over budgeting in terms of standards, and then at the same time over here, an adverse labor rate variance indicates higher labor costs. And so if it's a higher one, it can also be an increase in the wage rate. If you're hiring more skilled labor, then that might be more expensive. Inefficient hiring by human resources, and then effective negotiations by labor unions. So again, all of those can really impact my direct labor costs. And so when we look at the direct labor costs, what goes into the cost? Well, when I'm looking at direct labor, it's going to be the hours it took times the rate per hour. This is what I'm paying for my direct labor. This is giving me my total of what I actually paid. What I'm doing is I'm comparing what I actually spent on direct labor to what I budgeted, right? Meaning that how many hours should I have spent producing that particular quantity? So again, this looks a lot like direct materials, but now we're just dealing with labor. So what I'm going to do here is I'm comparing my actual hours and the actual rate, or my total labor cost, to my total standard cost for what I believe that labor should have cost me. That's going to be my very first step in terms of doing this type of question. So I'm going to figure out what is my total variance first. And then what I'm going to do is similar to the direct materials, is I'm going to be putting in what our middle value is. And what that's going to help us do is going to help us isolate these two variances here, or the rate variance and then the efficiency variance. You will notice very much here, this looks like the price variance, but because when we're paying people by the hour, we refer to that as a rate. So again, leaving my hours constant, then I'm able to focus on what I'm actually paying per hour. So the flip side of this, or on the other side of this, is my efficiency variance. How efficient was I in producing that quantity? Because I'm leaving the rate constant, I'm able to focus on the actual hours spent versus the standard hours. And this is giving me my efficiency variance. I'm not trying to steal something from an electric vehicle. It's just the way it came out. Okay. in terms of favorable versus unfavorable, let's just kind of remind ourselves of this, is that if we paid more for direct labor than we should have, the rate variance, basically the overall variance will be unfavorable. And then that's what we want to do first. We want to be looking at so if we're looking at just the rate variance here, if I paid more per hour than I should have, this is going to be unfavorable. If I use more hours than I should have, this will also be unfavorable. But again, the first thing I want to do is to compute that total variance. So in terms of the steps, we're going to be following the same kind of order. We're going to compute the total variance. We're going to put in the middle value. We're going to compare we're going to come up with the rate variance. We're going to come up with the efficiency variance, and then we're going to make sure that that equals the total variance. One other thing that I wanted to note, and I kind of just left this out in terms of in that very, very first slide, is that and this just kind of talks about it right over here and a little bit in terms of over budgeting, is that if I'm inappropriately high setting the standard cost of direct labor. So if I'm a manager and say, and this is something you always have to kind of worry about, is that, as the accountant, we are not, and this is not the Ben Affleck accountant, but as the accountant, what we're going through and doing is we're in the organization. We're not going to be experts on anything, on everything, excuse me. on anything might actually be true. We're not going to be experts on everything, but the great thing about accounting jobs is that you get to learn a lot about business. And in helping different parts of our business, we're going to be talking to the production managers because they're going to be the ones who know what does it actually cost to actually go through and produce something. So when we're talking to them, what we have to kind of keep in the back of our mind is what they're telling me realistic. What you may want to do is if they're saying, oh, this takes like this much time, what you may want to do is you may want to go and kind of do some research on your own to become more familiar with your manufacturing process and to really make sure is this person really, is they're telling me the truth. The reason why is that people have a tendency, and this is everybody, is to say, well, this is going to take me 100 hours to do. But if I can deliver it in 50, I look like a superhero. Maybe Marvel or DC, I'm not really sure, but I look like a superhero. So what we need to be careful about, and this goes throughout all the standard costs, is somebody inappropriately high setting the standard costs of direct labor. So if someone, and this goes true for direct materials, overhead, everything. So again, accounting simplified, thank you for really pointing that out because it's a really, really important part in terms of how we are going through and, figuring out, are we at budget, above budget, where are we at? So go back over here to our problem for today. And this is a continuation of what we were doing earlier, but FSI is manufacturing t-shirts and custom apparel. To make one shirt, FSI has developed a standard of 0.5 hours of labor at a standard rate of $15 per hour. Wow, the slide is now magically edited. So let's go through this again. So direct labor variances. So here's our example. So we manufacture t-shirts and custom apparel. To make one shirt, I've developed a standard of 0.5 hours of direct labor at a standard rate of $17.50 per hour. So to make one shirt, it's going to take me about 30 minutes or half an hour. So during the month of October, we produced 30,000 shirts that took 14,000 hours of direct labor at a total cost of $255,500. So what we're going to do here is we're going to follow the same steps. So what we want to do first is our step one is we're going to determine the total variance. So our total variance is going to be what I actually spent on the labor versus what I budgeted. So my total cost of my labor is going to be my actual hours times the actual rate, or what I actually spent on the labor. So to make the 30,000 shirts, it took me 14,000 hours at a rate, well, we actually don't know the rate, but we know the total cost of 255,500. So we know that this right over here, the total cost of this labor is right over here at 255,500. So what was my actual rate per hour? Well, I can figure that out using advanced math. So right over here, I've got my actual hours, or 14,000 hours times my actual rate per hour is equal to 255,500. So this should be my actual rate is equal to 255,500 divided by 14,000, or $18.25 per hour. So I didn't give that amount to you. You had to go through and figure that out. So, but can you figure it out? Yeah, because I actually used 14,000 hours of labor at a cost of 255,500. So that is my total. This is what I actually spent. Now, the next question is what should I have spent to make the 30,000 shirts? So if I take my standard hours times my standard rate, this will give me my total budgeted amount. So this is my labor cost for 30,000 shirts actual, my labor cost budget for 30,000 shirts. Okay, so I made 30,000 shirts, but how many hours should this have taken me to make a shirt? Let's take a look. So I made 30,000 shirts. This first part right here, so I manufacture t-shirts and custom apparel. To make one shirt, I've developed a standard of 0.5 direct labor hours at a standard rate of $70.50 per hour. So if I'm making 30,000 shirts, to do this here, it's going to take me 0.5 hours of labor. So the total hours of labor to make 30,000 shirts is going to be 15,000 hours. So this is how much it actually should have taken me to go through and do this. So right here, my actual hours of labor right here, I should have used 15,000 hours to make the shirts. And these here are my actual hours. So I now come over here as well. If I spent 15,000 hours, right, that's how much I should have spent to make the shirts. What is my standard rate per hour? Well, it tells me right here, my standard rate per hour is $17.50. So my total budgeted direct labor cost should be $262,500. So the first thing that I'm going through and doing is I'm figuring out my step one is my total labor variance, which is going to be my actual hours times my actual rate, less my standard hours times my standard rate, or 255,500 minus 262,500. And over here, my total labor variance is negative 7,000. Now remember what I said in the previous video. Do not think of this as negatives and positives. Rather, think about this from the perspective of, is this favorable or unfavorable? Well, the answer is right over here, it's going to be favorable. On an overall basis, I spent less than what I actually should have spent. So if I look at this right over here, I actually spent less on an overall basis. I spent $255,500. What should I have spent to make 30,000 shirts? Well, I should have spent $262,500. So I spent less. So if I spent less, this is going to be a total favorable labor variance. Okay, that's my step one. My step two for these kinds of questions is what I'm going to do now is I'm going to put in the middle value. Okay, so right over here, what exactly is my middle value? It's going to be my actual hours times the standard rate. And again, why do we put this middle value in? Because we need to further break down where this total variance is coming from. So for my middle value, what I'm going to do here is I've got my actual hours. So let's start it here. Okay. So what I'm going to do here is I'm going to be putting in my middle value, which is going to be my actual hours times my standard rate. My actual hours were 14,000. My standard rate was $17.50 per hour. So right here, my middle value is going to be $245,000, or the actual hours times the standard rate. So this is my step two. My step three is when I'm going to be in step four, is I'm going to be using this middle value to further isolate and see where these differences are coming from. So my step three is going to be to determine the rate variance. So my rate variance is going to be actual hours times the actual rate times the middle value of the actual hours times the standard rate, which will give me my rate variance. Okay. So here I've got 255,500 minus 245,000. So my total rate variance of 255,500 minus 245,000 is be 10,500. Why am I calling this the rate variance? Look at the equation. The actual hours are remaining constant. When I do that, I'm able to identify where the rate variance is coming from. So right here, I paid, and again, is this favorable or unfavorable? I don't know. What did I actually pay per hour? I paid $18.25 per hour. How much should I have paid per hour? $17.50. Why is that difference there? Frankly, I don't know, but it is there, and we may want to investigate it depending on how significant it is to our production. So right over here, this is going to be a total unfavorable rate variance because my actual rate per hour of $18.25 is greater than my standard rate per hour of $17.50. So that is my total rate, or that is my rate variance. Okay, so that's my step here. Again, if it's favorable or unfavorable, think about it logically. The next one here is to determine what we call the efficiency variance. So my efficiency variance is going to be my middle value less my budget. So why? So right over here, I've got my actual hours times my standard rate minus my standard hours times my standard rate. Okay. Why is this the efficiency variance? The efficiency for direct materials, we call the quantity. This is really efficiency though. How efficient were we in terms of making the product? So here I'm keeping the standard rate constant, and I'm focusing on the actual hours and then the standard hours. So by doing this right over here, I've got 245,000 minus 262,500, or a total value here of a negative 17,500. Is this favorable or unfavorable? I don't know, okay? But if I look at this here, how many hours did I actually spend making the shirts? Well, I only spent 14,000 hours. How many hours did I actually budget to make the shirts? Well, I actually spent 15,000 hours. So in this case right here, this variance will in fact be favorable because I spent less than what I had budgeted for. So this is going to be a total favorable efficiency variance. My actual hours of 14,000 are less than the standard hours of 15,000. That's what's causing this. So I've got my rate variance, I've got my efficiency variance. Okay, just remember, and when we're going through and we were doing it for materials, it was price and quantity. Variances here, it's labor, it's rate, and efficiency. So my step 5 is check your work. How do I check my work? I'm going to take my variances, which are going to be right here, my total favorable efficiency variance, plus my total unfavorable rate variance is going to be giving me what? My total variance of negative 7,000. This is going to be my total variance. When I add these two up, or negative 17,500 plus 10,500, I get a total variance of a negative 7,000, which is going to be favorable. Because remember, why is total variance labor favorable? And again, why is that, right? So on an overall basis, I only spent 255,500. I should have spent 262.5. So overall, it's favorable. I spent less. But where is that variance coming from? Well, it's coming from two parts. It's coming from the rate I'm paying per hour, which is unfavorable. And then I actually did it in less time, which is favorable. So again, that's what we're kind of going through and trying to figure out with these different types of problems. And so as I look over here in terms of walking through the various solutions, which I think are much more pleasant on an Excel sheet, so you can, or my Google sheet, so you can see how inefficient I am at using spreadsheets. But this is what we're doing. Again, we're checking our last part over here is checking our work. And then I want to thank you for joining me today here and watching this. If you have any questions or comments, please send it to 1812cpa@gmail.com. And I will see you on the next video. Have a great one.